so much, Zach, for joining in and coming to be a comic guest on our show, or my show, the only one. um, so before we start, just wanted to ask you if you can introduce yourself. Just tell us a little bit about yourself, your upbringing, what you do currently. Just a little summary.
Yeah, sure. Thanks. I really appreciate being on this show. And yeah, Zach George, I am originally um, from the south of India, but I grew up most of my life in the Middle East in a small town called Muscat in Oman. Spent 17 years of my life there living a very international sort of expat, third culture kid lifestyle. Um, Grew up in the 80s and early 90s. Was a complete geek and nerd at school, so engineering was the sort of career path that I chose right after high school. I moved to India and got my undergrad degree in mechanical engineering, and shortly after went and got my graduate degree, a master's in corporate finance from Stanford in California, and following that went and spent most of my 20s working on Wall Street, first at Lehman Brothers and then at Barclays.
Yeah.
And post the financial crisis of 2008, I had a bit of a head heart career shift and decided that I would move away from investment banking eventually, which I ended up coming good on. And in 2010, when I found myself in South Africa watching the World Cup, the Soccer World Cup, I found it as a perfect landing spot, a soft landing spot, Cape Town that is, to forge a new sort of career in the world of venture building, acceleration for technology startups, impact investing, a bit of angel investing, and that's now been formalized into the venture fund that I run right now called Launch Africa. But it's been a 13-year journey, and happy to unpack some of the things that we've done during that time frame.
What prompted the shift into VC, venture capital, or startups in general? Because that's kind of a whole segment of business that's its own niche thing. So what prompted that move?
Yeah, it's a lot of things. First of all, I think if you spend too much time in a large corporate, but specifically in financial services, you can get quite disillusioned with the purpose of why you're doing something. I think from a pure financial and economic standpoint, the rewards are there for the taking in financial services, but you put your heart and soul on the line. And I have nothing wrong with working ridiculous hours, provided you're doing it for something that either you created or you're working towards a greater purpose and mission, and not just in increasing the bottom line for a large corporate where you see there's no soul in the work you do, right? And I think in your 20s, it's very easy to be disillusioned, or rather just do what you're told because you have to do it. And in your 30s is when you start to form ideas and opinions of your own. And that's, I mean, at least at least for folks in our generation, which is sort of the Gen X's and early millennials, that sense of purpose and significance, not just success, is what drives a lot of, and it's actually more prominent now in the Gen Zs. It's money alone without socio-cultural and economic, and to a certain extent now environmental value add, does not fulfill a person in its entirety. So
was there a single moment where you actually realized that actually I don't want to do this, or was it just a build up? And then what was kind of like what I think it's called the straw that broke the camel's back?
Straw that broke. A big part of it was, remember, I worked at Lehman Brothers in 2000 and 2004, um, and obviously the bankruptcy happened in 2008. So I was at Lehman for 5 years, well, 4 to 5 years. And that bankruptcy, at the time, the largest bankruptcy in global history, was quite a catalyst in not in me leaving the industry because I did stay on for another 2.5 years, but it was a catalyst in me seriously questioning what I was doing and why I was doing it, right? So that was a big moment. I remember it was Sunday, the 15th of September, 2008, or thereabouts, on the 14th, whatever. And it was a day when we realized that our firm was going bankrupt and that our assets would be seized by the state of New York on Monday morning. So that realization that all you'd worked for in the previous 4 or 5 years would essentially just come to a grinding halt. And I say that because, as an investment banker, most of your salary is, or not most, but a big portion of your salary is in stock. Um, and that stock vests over a 3, 4, 5 year period. And you wake up one day and you realize that all of that is gone. And you have no recourse to it. So you start almost questioning yourself, saying, if businesses do not, um, if businesses pay more attention to profits and not purpose, without understanding that you can do both, because any organization, from a startup to a large Fortune 500 company, has several stakeholders. You've got your customers, you've got your employees and your staff, you've got the owners themselves, you've got investors and shareholders, and it is very hard to maintain a balance between making sure all your stakeholders are taken care of and their needs are met. And I think large corporates tend to at some point lose their soul the bigger they get. So the bankruptcy of Lehman was a big catalyst in me eventually leaving a couple of years later. Another important fact was I've always, even though I didn't grow up in Africa, my father was born in Dar es Salaam in Tanzania, and he grew up in Tanzania. So I've always had an intellectual curiosity about my roots. I also spent 6 weeks volunteering in an orphanage in Hohoe, which is a small village town about 4 or 5 hours from Accra in Ghana in 2008. Funny enough, just a few weeks before the Lehman bankruptcy. So I've had this head-heart conflict to say, the work that I'm doing as an investment banker is not really solving significant problems in the world, be it in education, in inequality, in food, water security, healthcare, and often people that have the privilege of having gone to good schools and had worked in good companies, people that have influence networks and connections, don't usually use it to do good. And the people that want to make a difference don't have the time. Well, have a lot of time, but they don't have the capital, and more importantly, the networks and resources. So I felt that it was almost incumbent on me to do it. So when I saw the opportunity in 2010, 2 years post the global financial crisis, I just felt that I had to do it now. And if I didn't do it now, I would go down the slippery slope of being an investment banker for the rest of my life. Because remember, one thing about corporate is the longer you stay in a corporate, they call them golden handcuffs. But it's the harder it is for you to leave. So every incremental year I stay at a corporate, but specifically financial services, your salary, your bonuses, your benefits are all tied into your work. The longer you stay, the harder it is for you to leave because you've got so much more to lose.
So what was your initial exposure? Because you speak about opportunity that arose during that time. What was it initially, venturing into VC, and what was your initial exposure to that, or was it just something else? How did you get into the?
No, I mean, I always knew that there was an opportunity for. I mean, if you look at most countries in the world, not just the US, but most countries in the world, the life and blood of the economy are small businesses,
Yeah.
or is small businesses. So we're talking
Like
anyone.
a small business banker.
Yeah, I mean, yeah, I mean, you call them SMEs, SMBs, whatever you want to. So, in fact, MSMEs, micro, small,
Yeah.
medium, and then large enterprises. But even if you look at a country like South Africa, where I've lived for the last 13 years, it's the large corporates or enterprises, from the Sanlams to the MTNs to the Standard Banks to the Pick and Pays. They aren't the ones that create jobs. They do create jobs, but they pale in comparison to the M's, S, and the M's of the MSME. So the businesses that employ anywhere from 5 to 10 employees, 10 to 100 employees, and 100 to 500 employees are the ones that create real real sustainable um, jobs in not just this country but all over the world. And those are the businesses that struggle the most with funding.
Yeah.
For many, many, many years, if not decades, in certain cases centuries, the only viable form of capital to small businesses and SMEs or MSMEs was bank loans.
Yeah.
And not every business is built to take on bank, high interest, high inflation linked debt instruments.
Yeah.
Especially if your core value offering is linked to a cyclical industry like agriculture.
Yeah.
Right, which is a core of a lot of businesses in not just Africa but also Southeast Asia and Latin America, right? So there was no funding for things as diverse as working capital, for technology, for product, for R&D, for marketing. So you cannot have a one size fits all where a bank gives you a loan and you have to use a loan for 8 or 10 different things, all of which require different duration from a financing perspective, different terms, different inputs. So, for example, if you take a loan from the bank, but you're using the money to help build technology, there isn't a cash flow associated with that technology until much later.
But was that what you had set out to solve when you decided to leave the banking world? What problem were you looking to solve?
Yeah, it's just access to opportunities in finance for small businesses and entrepreneurs all over the world, but specifically in Africa, because it was one continent that was still left out in the cold in terms of smart capital. So if you'd noticed, India had its sort of technology revolution. So the Indian economy opened in the early 90s, 1992, 1993, liberalization of the Indian economy, and you saw this huge investment into IT. Obviously, India has a long history of academic, focus on academics and intellectual excellence.
Yeah.
So India has some of the top universities in the world, just in Asia, just alongside, China and Singapore, for example.
Yeah.
But the growth of the Indian economy into now what the third or fourth largest economy in the world was primarily because of the tech revolution in the late 90s and early 2000s, becoming an IT superpower. And we hadn't seen that in Africa.
Yeah.
Even when I came here in 2010, Africa was still lagging behind. There was no real, venture builders, incubators, accelerators, venture capital were still unknown concepts. Africa is to a large extent, even to this day, run by oligopolies.
Yeah.
Right, so you've
Very
got
much.
4 or 5 big insurance companies, 4 or 5 big banks, 4 or 5 big telcos, and they spread their, arms, legs, and feet all over the continent through subsidiaries, through JVs, etc. So it becomes very hard for small businesses, and by extension startups, to compete against uh, the I was going to say monolithic, but similar sort of monolithic power and distribution
Yeah.
that these large corporates have.
Yeah.
So the only way to be innovative as an entrepreneur is to start working with these large corporates,
Yeah.
and not against them.
Yeah.
You can work against them if you're in a market where there is a lot of risk capital available at the early stage of a business's growth, but you don't have that luxury anywhere in the world outside of Silicon Valley and possibly Beijing in China. So, in the absence of smart capital at the early stage, the only way that you can grow businesses that have an innovative tech component to it is by working with these corporates. So basically looking at B2B2C business models
Yeah.
and figuring out how you can involve large corporates in Africa as part of your distribution.
Yeah.
And that's basically what I started doing in South Africa back in 2011 and then henceforth.
Yeah. So you talk about the best way to build businesses or build businesses in Africa is building something that's B2B2C.
Yeah.
So working with the corporates. What's the biggest struggle for companies that are trying to go direct to consumer in Africa?
It's first the most obvious one is how do you find customers? How do you? I mean, take for example South Africa. South Africa has what is it, close to 50 million people, if not more than 50 million people. You try starting. I mean, give me an example of a tech startup in South Africa. Just give me some.
Yoko.
Yeah. Okay. Good
That's
example.
Yoko's
Yoko.
pretty
Yeah.
good.
Yoko. Yeah.
That's
Yoko is.
B2B,
But like let's say you're as little as you're running an online shop to sell, I don't know, secondhand used laptops.
yes.
Right? And it's a marketplace. How do you acquire customers? How do you tap into 50 million people in South Africa? How? You can't. You can't. It's not like the West. Well, it's the West. I mean, it's not like Silicon Valley where you can just okay. I'm gonna just throw money on um, paid marketing, Google Ads or Facebook or Instagram, because what percentage of South Africans are online?
Yeah.
What percentage of South Africans are on mobile devices? Higher than online, but it's still, so you can't and you can't like splurge money on radio, TV ads. I mean, you could, but what are the conversion rates of these things? So the reality is, when you look at emerging markets, like, India is a little different, but India and China are a little different, but like Southeast Asia, Latin America, and Sub-Saharan Africa, and the Middle East, you've got to figure out what is the quickest, most efficient, and most relevant way to acquire customers, paying customers, and once you acquire them, make them as sticky as possible. So minimize churn.
Okay, but then what about the fears that startups face about being absorbed by a corporate too early on? Isn't that also kind of a worry, or do you feel like they shouldn't be worried about that?
I mean, ultimately, as a startup, you control your exit, right? If a
Yeah.
corporate wants to acquire you, you can say no,
Yeah.
right? I fully agree. That's actually a really good point, John. Where a lot of acqui-hiring situations in South Africa are done by corporates as a way to. So, I mean, I personally think a lot of corporates in South Africa and maybe possibly across Africa happen without a clear strategy as to why do I want to hold this asset for what reason. So if you take the big media companies like Naspers or the big insurance companies like Sanlam, Momentum, Old Mutual, or the big banks, a lot of them will acquire startups having done a small POC, proof of concept, or a pilot, or maybe a commercial deal with them. Um, and they would do these acquisitions based out of a fear of missing out, FOMO, more than any clear path to market domination, right? So we saw that in the case of, for example, Old Mutual buying 22/7,
Yeah.
or Standard Bank buying SnapScan, and there are a host of corporate acquisitions of smaller tech startups that went horribly wrong. And I think, and it's no one's fault, but if you're getting, you know, the fundamental disconnect is how can you get a corporate that is run completely diametrically opposite to a startup? The goals are very different.
Yeah.
To now run a startup business, absorb it into a corporate, almost every corporate acquisition of a startup will lead to a big drop in growth
Yeah.
post acquisition. It's because corporates will focus on customer retention, profitability, and integrating a startup's operations into its
Yeah.
value chain, its suppliers, its marketing process, its operations, which is what you are taught every day in Finance 101.
So it's also growth and innovation, but also, don't you think that's also, I don't have a better word, but to some extent, somewhat problematic in the sense that it actually um, discourages like the full-on growth of like startups if their best situation or their best bet is to actually work with the corporate, because then all we're doing is we're still consolidating power with these big corporates and they get bigger, and obviously we know that they don't have much incentives to bring on competition because they don't want competition, and they've kind of set up the field or the playing field in a way that actually prevents competition. So if if we're encouraging, let's say, startups to actually work with, which I don't think is bad. I think it's a smart bet, but it's like it also does have its own risks. I don't want to say that's it's completely bad, but I do see a case where if corporates, let's say, start spending a lot more on buying startups that are doing well, then I think long term the effects on startups and just the general ecosystem is going to be somewhat negative because they essentially squeezing competition. But again, it's the whole antitrust buying of competitors to reinforce a monopoly. But then the only difference is that they might be doing it at a much earlier stage than if the company had become bigger.
Yeah, I mean, it's a very good point, John. It's like corporates are are getting smarter, and they would rather pay a much smaller price to buy a startup that hasn't peaked yet in terms of its product market fit or problem solution fit, and bet that they can do a better job at helping scale the startup than the startup itself.
Yeah.
There have been some cases where corporates have got have gotten it right.
And when it's wrong, what happens?
If they get it wrong, you're essentially killing the startup.
Do you
Yeah.
not see that? Is there a case
I've
where
seen-
it kills an industry or kills the opportunity?
It kills the opportunity because ultimately
for other players.
for the players. Yeah, I mean, if you take for example payments, right? Like honestly, I give this example of how the technology of SnapScan was predated Apple Pay, right? So this whole like I can pay a merchant through a QR code that's linked to my bank account, and it is device agnostic, operating system agnostic, and to a certain extent payment mode agnostic. And it just needed capital to scale, to acquire merchants. But because the bank, in this case, Standard Bank, was so adamant that they would acquire the business fully and integrate it into their banking infrastructure, they killed the company. I mean, Apple Pay is a household name globally with hundreds of millions, if not billions. I'm not sure what Apple Pay's users, usage numbers are, but why could SnapScan not have become as big as Apple Pay?
Yeah.
And its features were far superior to Apple Pay at the time. Apple Pay to this day cannot be used by more than half of the world's population that don't have iPhones.
Yeah.
Right. So it's a bit disconcerting how corporates can sometimes kill startups because they shut down avenues of growth that founders would typically have no fear of. So it's also, remember, when you buy a startup as a corporate, you have to follow enhanced governance, compliance, and regulatory frameworks that align and adhere to your own corporate best practices.
So how do startups then? Because I am hearing it. So obviously there's a negative, but then there is also positives to working with corporates.
Yeah.
But how do you kind of encourage startups to actually think about the whole process of finding a corporate partner
Yeah.
and ensuring that the partnership actually serves the startups a lot more than the corporates, because I think you typically want the startup to win. I think,
Yeah.
and it's good for the ecosystem. It's good for the general story, for everyone to see that, okay, there was this company. It started off the kind of the rags to riches kind of story, and I think corporates have already lost that because they've been big for too long. But then I think the more successes come out, the more it inspires the ecosystem. But if all of these successes are just getting bought up and the stories never get continued, then
Yep. No, I fully agree with that. I mean, it's the solution, as I've said before, is that corporate should not be taking equity stakes in startups prior to the startups reaching at least a point of terminal velocity. What I mean by that is, you should never be acquiring a startup pre-Series A.
mm,
I would say even pre-Series B. You should let a startup grow to a point where it's generating $5 to $10 million in annual recurring revenue, and then a corporate should say, okay, um, is it worth it for me to acquire a majority stake in this company, or acquire it fully, and am I able to create a new um, paradigm shift in the industry through my acquisition of this company, and can I dominate the market because of it? That, so for example, Microsoft's acquisition, or not acquisition, but significant stake in ChatGPT is one example of that, right?
yeah,
Microsoft can add a huge value to to OpenAI because Microsoft has huge access to distribution channels, enterprise as well as retail customers through, yeah, I mean all their Microsoft 365 Office suite, etc., where that could be a built-in feature, right? So you're not killing a startup, you're enhancing it through your distribution, but you're not acquiring them fully.
yeah.
You know, a good example of what not to do is someone like Microsoft buying Skype. Skype is dead,
I
right?
know some people that use Skype.
Yeah, the keyword being some people. Like no one in that I know of uses Skype for calls anymore. People use WhatsApp for calls. If it's business calls, you're using Zoom, you're using Teams or whatever. But funny enough, also owned by Microsoft.
Yeah.
But Skype is dead in the water because it was a full-on acquisition without any real strategy. Which is why I always say, let a startup grow organically through venture funding, which is minority, keyword being significant minority investments into startups
Yeah.
by non-corporate parties that are working in a non-exclusive environment.
Yeah.
The moment and this is what corporates get wrong sometimes is having a corporate on your cap table pre-Series A.
Sounds horrible.
Yeah, you'd be amazed how often it happens. Is not only a negative signal um, for the startup because of a dilution perspective, but it will turn away other potential investors because they know that you've cut out an entire part of the market that will not invest or work with you because of your exclusionary um, terms. So, for example, I mean, I'm just making up a hypothetical example. If you have four major banks in a country, and you are a fintech in that company that is, let's say, enabling real-time bill payments through QR codes, as an example,
Yeah.
and you have one of these four banks that is acquiring a 30% stake in your company, now all of a sudden, um, any partnership with the three other banks is out the door. You
Yeah.
can't,
Yeah.
right? Because you have a significant stake in your company by a dominant or one of the dominant corporates. So it actually sends a negative signal to the rest of the market saying, okay, the path towards exit is now essentially being halved or cut in two-thirds because ultimately a startup needs to either list
Yeah.
or be acquired
Yeah.
or be profitable enough to pay dividends or long term. The last option isn't that common,
Yeah.
right? Now, if a corporate has a majority stake in a company or a significant minority stake in a company pre-Series A or even pre-Series B, you're effectively cutting off or siphoning off any further strategic investment options into that company because the corporate is essentially saying, I've taken such a huge stake in your company before you've even started your J curve that the only option you have as a founder is to sell the remaining ownership to me.
Yeah.
And the lesser buyers you have for a product, the lower your price, which is why South Africa, for example, has had the lion's share of exits in Africa. This is an important point. Of the 140 odd exits in Africa in the startup world, almost 40, if not more than 40, have come from South African corporates buying South African startups in the last 4 years. But the multiples that they pay are horrendous because if you only have three or four potential buyers, what happens? It's simple econ 101. The price goes down.
Yeah.
The less supply you have, um, the less suitors you have for a product, the lower your value is, even if it's only perceived value.
Yeah, that's so interesting, and it's
Whereas if you are going down the horizontal M&A route, where you're not looking at vertical buyers, which are corporates buying startups,
yeah,
you have a much larger universe,
yeah,
and it makes the the likelihood of a startup being fairly valued a lot higher.
yeah,
So let's give the same example. If you are um, a peer-to-peer payments startup using QR codes, as a generic example, and and all the investors on your cap table pre-Series A are either angels or VCs.
yeah,
There's no single corporate or institution that has vested commercial interests in you. You work with everyone. You're truly non-exclusive. Your universe of potential buyers could be banks. It could also be asset managers. It could also be insurers. It could be lending companies.
yeah,
It could be telcos from a customer data perspective. So you have this positive tension between potential acquirers, which places the power back in the hands of who? The entrepreneur.
yeah,
And that's why the price is more fair. And that's what you see in mature economies, but you don't see it that often in economies where you have large oligo, oligopolistic
yeah,
tendencies.
yeah,
Nothing wrong with oligopolies. Oligopolies in some situations can be a good thing,
yeah,
but you have to differentiate between commercial partnerships and equity based investments. In my humble opinion, and it's been tried and tested for the last 10 plus years, equity should only be on the table post Series A, preferably post Series B, once you have enough smart capital
yeah,
that has helped you grow to millions of dollars in recurring revenue, and then a corporate should consider investing through corporate venture capital um, funds.
yeah. But it seems very obvious. Well, it seems obvious when you think about it, but I think a lot of companies just get excited by the money.
Of course. Yeah.
But let's just move to kind of like the capital markets.
Yeah.
Like, what does that look like currently? I know there's a bit of a dry season happening
Mhm.
right now in Africa, especially when it comes to the early stage fundraising. So I just wanted to get your opinion on what that's looking like right now, and how do you think startup founders can actually navigate the space? Because although the capital's is running a little dry, the amount of new ideas and new startups getting started is not. So
Yeah, I mean, it's a great question. I get asked this all the time. In fact, that's been the dominant question almost every week this year. Um, yeah, I mean, it's simple. I mean, by the way, this is very normal.
Yeah.
That's the first thing I'd say is I've lived through now, I'm 41. I've lived through, if I'm not mistaken, one, two, three, four, five. This would be my fifth quote unquote recessionary environment,
Yeah.
right? I mean, not that I was reading books in 87 with the stock market crash, but 87, um, 97, 98, Asian financial crisis, 2001 dot com crash, 2008 um, financial crisis at Lehman Brothers, 2000 and um, 19, 20 slight COVID dip, and it's technically my sixth crisis. So this is normal. This is very, very normal. These are classic um, quantitative easing, quantitative relaxing economic cycles. This is an economist's dream to be able to predict this.
Yeah.
This is normal. But when you're in it, it feels horrible. Right? So we've been in a recessionary environment, predominantly because of two reasons. One is the war in Europe is not the main reason.
Yeah.
It is a factor. But the biggest thing is the rise in interest rates in Europe and the U.S. Right. So we had almost what was it, 2008, more than a decade, 10 years of near zero interest rates in Europe and Western Europe at least, and the U.S. and North America. Right, 10 years. It was almost too good to be true. So you're able to borrow if you're a small business, if you're a large business, I mean, money was essentially free for 10 years, essentially free, and that creates a situation where people overextend themselves, not just businesses but individuals and families. And Alan Greenspan, the former Treasury Secretary, if I'm not mistaken, um, use the term irrational exuberance, and that's essentially what happened. And the moment you have um, a slight disruption in underlying assets, be it homes, be it um, assets, cars, be it just I don't know. I mean, the COVID crisis, you could argue was um, a stark realization that we had overextended ourselves. There was too much money. There was too much supply of free money.
It was after COVID. When
After COVID, yeah,
Fed
sorry,
printed out
just too much.
a couple of trillions.
There was too much money in the system, and it was practically free.
Yeah.
And the underlying assets weren't as good. So it's almost like you open the hood and you're like, geez, why is there so much money in these businesses? And then to stymie inflation, the Fed in the U.S. and then similarly in Europe had to rise, as to pump up interest rates.
Yeah.
And simple, correlation and between quantitative um, easing and tightening, respectively, and you had people pushing back, and now the cost of borrowing is very high. As a result, people spend less. So what you see is when you have cycles like this and the market tightens, the first industry that will feel the pangs are unlisted private markets. So
Yeah.
that's private equity, that's venture capital, that's anything that's an alternative investment um, asset will take a hit, and people will flee, quote unquote, to the safety of fixed income, so bonds, treasuries, and then stocks, but diversified. I'm talking, um, blue chips, for lack of a better word. So you see a big run in a bull run in equities.
Yeah. So this isn't what's happening right now with the dry span in terms of venture capital and its availability in Africa isn't necessarily a result of lack of investor confidence in Africa, but more so as a result
No,
of just a global
yeah,
recession.
it's a global recession that the effects of which are far more far fetched in the U.S. and North America and Europe to a second degree than Africa. I mean, yeah, you have the usual sort of systemic risk in Africa. There's geopolitical risk, there's currency risk, and all that. But this recession is not fundamental to Africa.
Yeah,
Africa is not at war.
yeah,
Africa, you know, I joke around to my friends in the West saying, you know, we in Africa don't know what a low inflationary, low interest rate environment actually means. We've always had high interest rates,
yeah,
high cost of borrowing. So this is nothing new to us.
yeah,
So this what this is this is a huge problem that has trickled down from the US, from Western Europe into Africa because trade between different regions of the world has only increased over the last few generations.
yeah,
So prior to this, a sharp increase in interest rates in the US and Europe would have had a lesser effect in Africa because intercontinental trade was not as big as it is today. Today we live in such a interconnected global supply chain, a free flow of goods and services between continents. It is impossible for you to survive as an economy in a complete, isolationary environment. You cannot, right? So if you're an African producer of, let's say, coffee beans, and you're roasting them in Europe and selling them to coffee shops in Boston or New York, if people, because of higher interest rates in New York, are not drinking as much coffee, that means you're not having enough roasters in Italy sending coffee to the U.S.
yeah.
As a result, less roasters in Italy are buying coffee from farmers in Ethiopia.
For 101.
Eco 101, right? But 100 years ago, people that produce coffee beans from farms in Ethiopia, I'm just giving you a very simple example, wouldn't typically be selling their coffee at Starbucks in Manhattan.
Yeah,
So there was more of a disconnect between regions. So you could survive and you could thrive. I mean, take it back a few centuries ago to India.
yeah,
India had the world's largest textile industry
yeah,
for hundreds of years, and it was primarily self-fulfilling.
yeah,
Silk in China, another example, right? I mean, I can go on forever. I mean, I'm a bit of a history buff as well.
yeah,
But you can't do that, right? The world is so. I mean, COVID is the best example of this, right? What started off as a small outbreak in a tiny part of a province in China became a global pandemic very quickly. The same thing with economic pandemics, if I may use that term, right? So you cannot afford to. So the crisis that's happening right now in the world, from an economic perspective, did not originate in Africa.
yeah,
Did not. But we cannot but feel the effects of it.
yeah,
And it has made its way more prominently in the manufacturing world, the heavy industry world, in free trade in trade and development. And yes, venture capital is affected,
yeah.
but not even close to how correlated other sectors are.
Yeah. Okay, so what do you think the best approach for startups building businesses during this time should approach fundraising or even just the structuring their business during
Yeah.
this kind of dry season? Because obviously there's companies that have already received venture capital and are looking to raise a next round, and I think everyone's currently still, well, a lot of the VCs are still actually just raising money from well, other LPs globally, and yeah, and I think the projections for how much money is going to be is going to come into the African economy is a lot less than we had in the past 2 years. So the reality is not everyone is going to get funded. So how should they actually go about structuring their business or structuring for this market or
Yeah, I mean, I think if you look at where the world is from a venture perspective, let's just talk venture for a second. We're just moving back gradually to pre-COVID levels.
yeah,
So I think COVID was an insane, almost irrational spike in venture funding,
yeah,
and the sort of rising interest rates, very quickly rising interest rates to curb that extremely high inflation. Um, this people need to put the handbrakes on.
yeah,
So startups should continue to go back to the drawing board and focus on, if I'm building something of value to someone or something or an organization, I need to have a path to profitability. I need to be more disciplined in my unit economic calculations.
yeah,
I can't just expect to almost throw money into marketing and customer acquisition and sales without figuring out, is this a fundamentally sound business venture? I think a lot of startup founders became way too lax about not just that, but things like governance. I mean, how many startups do you know of, or do we know of collectively, that have advisory boards or governance structures in place, and have just, as the saying goes, like, flown by the seat of their pants?
yeah,
And founders got too cocky. Founders got too lazy. You know, money was money was free. The champagne flowed, and people just didn't realize that there would be a day when money would not be that. The value of money was lost.
yeah,
And the sad thing is, we've seen this movie before, but people never learn.
mm,
So I think startups have to be a lot more um, cautious when it comes to financial management. Um, they have to learn to offer better terms to customers, um, to negotiate better with suppliers in exchange for long contracts. You've got to learn to incentivize your employees with a combination of cash and stock. So you've got to find the right incentive structures that works for your team. You've got to be better in terms of not having to raise or to focus purely on equity as a means of keeping your business alive. So you've got to look at creative um, structures for your cap table. You could look at venture debt. You could look at revenue-based financing. You could look at working capital loans.
okay, acquired by corporate.
No, you might have to in this environment if you have no other option. But it's tough. And I mean, again, I say this with all humility. Like, I personally think less than 0.1% of entrepreneurs should be entrepreneurs. I think entrepreneurship has been glorified way too much in the last couple of decades. Ever since the explosion of the internet, and more so the explosion of the marketplace model and decentralization of assets, you have young folks graduating out of universities today who would make perfectly viable and good professionals in the medical field, in the legal field, in the banking field, in the accounting field, in the services industry, in the manufacturing, anything. But because entrepreneurship has been over glorified, you have folks that don't have the creative passion, zest, and hunger, and the ability to work in extreme environments of lack of structure to be an entrepreneur. But they choose to be an entrepreneur because it's cool, it's sexy, it's the new vibe, and that's what everyone is doing. I remember when I was a kid in the 80s and 90s, like an entrepreneur was like not even number 10 on a career path choice, not even in the top 20. Now, because you've had so many um, success stories of entrepreneurs, people forget that for every success story there are thousands of failures, but no one wants to have a glamorized failure, right? So I don't think, and there's a big distinction between startups and SMEs,
Yeah.
right? Like I mentioned, a while ago on this talk, like SMEs are the life and blood of an economy, but everyone wants to be a rock star. Everyone wants to be a tech founder. The number of people that come to us as Launch Africa, we're the most prolific and active research fund on the continent, that come to me with pitches saying we're going to be, the Uber of Africa, we're going to be the Stripe of Africa, we're going to disrupt payments through blockchain, we're going to use AI to change the way schools run their LMS software. And the entrepreneurs know nothing fundamentally about the industry or competition or channel distribution, who the major players are, what their routes to market are. So it's I mean, I was going to say, like, maybe we need a cleansing of the ecosystem.
Cleansing.
Yeah, where if you're not fit to be an entrepreneur and you're not able to keep up, then maybe it is time to be left out. And it sounds horrible as a venture capitalist myself, because I mean, our money comes from investors who trust us to make the right decisions on their behalf.
Right, so what are self-reflection points for the entrepreneur that is simply not good enough, that's chilling at home, listening in, and what should they look at about themselves, and what questions should they ask themselves about their ability in what they are doing right now and whether they actually can do it?
Yeah, I mean, like, first of all, do you have the mental, physical, and emotional stamina to hunker down and just grind through several years of, I mean, I would almost call it trauma to a certain extent, of running a startup, because this is not unusual, this environment. It will happen. Um, and the one word I keep coming back to often is resilience. Resilience is not to be confused with stubbornness or blind hope or passion or motivation or grit. Resilience is just the ability, resilience is not being stubborn and believing that what you're doing is correct, and that whatever you are facing, whatever headwinds you're facing, is pure bad luck, and it's only a matter of time before you come out. Resilience is the ability to actually pivot and change even the core of what you're doing, because you make a true and concerted effort to understand why a product market fit that may have been possible earlier is not possible today, and that you can pivot and change based on what the market needs are,
Yeah.
and not what you think you're selling. Every major successful technology startup has pivoted several times, and there's no shame or loss in glory if you change the core of what you're doing, provided you know why you're doing it.
Yeah.
So not everyone's got to be. It's got to be an entrepreneur.
So is it the creativity? Is it the creativity? Because somebody could be resilient doing the same wrong thing and
Yep.
be adamant. So is it the creativity that actually really separates the?
It's creativity. It's humility. Right, that's super important. Like, I've met some entrepreneurs who are incredibly arrogant and just have this huge, almost like unformidable ego that is so hard to penetrate, and you can't do that in this industry.
Yeah.
I mean, unless you happen to be someone like Andy Newman or someone like that from WeWork, who's got incredible arrogance, but also for whatever reason has made a few people a lot of money and can continue to act and behave like that, which I think is absolutely despicable. But for the most part, humility, adaptability, the ability to the ability to give more than you receive. It sounds fairly trite in terms of advice, but people who can add value to others more than what they expect in return, I fundamentally believe, um, um, if not in that particular venture, will build successful ventures and significant ventures going forward.
Yeah. So let's go 5 points on entrepreneurs that suck, and then 5 points on entrepreneurs that are actually going to be rock stars and will be okay. And okay means they might not win now, that they'll win someday. Um,
Yeah, five is a lot to think of like on the fly. But I mean, gosh, I'll just give a few, and I'm not gonna count
that's
here.
okay. You don't have to cut.
Yeah,
Start with the ones that suck.
the ones that suck are people that wear blinkers like racehorses. They only have a one-track mind, and they only focus on their product and their tech without looking at what the market actually needs. That's a big red flag. Entrepreneurs that are just outright dishonest and that will do anything to make a buck.
Yeah.
That's I see a lot of them. Entrepreneurs that just don't do enough market research.
Yeah. So so I run a software development company, so we get approached by a lot of startups, and I think my favorite phrase now when I speak to them, because I find it hard to just take money from people knowing that actually this person is not prepared to start a business. And what I usually say to them, and this is my favorite phrase, is you're starting a business, you're building a business, not a product. And a lot of people think that they're building a product and they only want to obsess over the product, but then they haven't actually thought too much about the market strategy and how they're going to actually go to market, whether people even want the product. It's like, I've got this idea, it's super awesome, and you're gonna build it for me, and I'm gonna scrape whatever cash I have, and they don't even understand like basic words basic phrase like customer acquisition cost.
Yeah.
And they don't understand the basic, but I get it, because there isn't really much of a startup culture. There is, to some extent, a glorification of entrepreneurship, but not much of a startup culture that actually educates them on how to build startups. And I think US has a little bit more about it, so it's easier to pick up on the jargon. But yeah, I typically also just really hate working with people like that. So I'm even on my side with my business, I'm trying to figure out how I can move away from the early stage startups, because most people just don't get it, to be honest. And I'm not claiming to understand all of it, but it's just like, at least understand the basics. At least understand the basics. And another big thing is people completely distancing themselves from the tech. They're like, okay, the tech is somebody else's problem. I don't want to work on that. But you are trying to build a tech business, and you don't even want to learn a little bit about it.
Yeah.
And that's why a lot of people get burned, because their ignorance kills them in the long run. From the experience that or I've had with a lot of startups, but also the arrogance.
Yeah, and I mean you touched on a lot of important points now. I mean, I always say, like, I have this thing called always be learning. I mean, if you ever watched a movie in the 1990s called Glenn Ross, Alec Baldwin says famously, always be selling. Also, always be closing.
Yeah.
And that's for salesmen, and I get it.
For my sales team.
Yeah, always be closing. But in as an entrepreneur, I would always say, always be learning. Technology is accelerating at such a rapid rate that if you're building something, your technology, your product or service offering could be obsolete so much quicker than what you think. I mean, if you just look at the adoption of blockchain into industries or the adoption of AI into industries, or large language processing models into industries right now, I mean, we're talking like a couple of years or maybe a few months, an entire business's core business model or value proposition destroyed overnight, right? So you've got to always be on top of things and figure out, which is why I mean, this is not relevant for a seed stage company, but once you're post Series A, you have to have a team that specializes and whose sole job it is 24/7 on product R&D. You've got to have a V2, a version 2, a version 3, a version 5 of your product in the pipeline constantly, even if it's in beta, that can combat any obsolescence in the industry caused by a new piece of technology. And those developers, software architects, whatever, should be obsessed um, by that piece of technology. And that applies to any industry. I mean, look at, for example, the education industry, something that I'm very passionate about. I don't want to predict this, but I actually think that, universities and traditional schools, the way we know it, will probably not exist in their current form in the next 20 years. I mean, look at the Harvards, the MITs, the Stanfords of the world, the Oxfords of the world are now making the vast majority of their content completely open source.
Yeah.
Right? They would never have considered doing this as little as 10 years ago. Right? Because they know that, you know, um, the lifeline of traditional learning has changed. The smartest corporates in the world, the smartest institutions, aren't hiring people based just on degrees. They're hiring based on experience and skill and the validity of um, your skill set to what the job requires, right? So you've got to really look at, I mean, and then there's the threat of automation, which is a whole new other topic. So all this being said, like as a startup founder, you've got to constantly be on top of your game in terms of knowing what's happening in the industry, and that's a big, I wouldn't say a red flag, but it's a big thing that we look at. Is like, tell me about your R&D team, tell me about your product team, like what are you guys, prove to me that you guys are on top of trends in your industry. That's on the flip side characteristics of a good entrepreneur. And by the way, good entrepreneurs will always have advisory boards to get industry leaders to sit as sounding boards, advisors, in exchange for equity. By the way, I'm going to go out on a limb and say, like, nothing in life is free.
Yeah.
It always involves an exchange of either time, money, um, intellectual property, um, in kind. There's always some value exchange.
Yeah.
The only exception being philanthropies and charities. But even philanthropies and charities have some sort of a social or political currency, right? So
Yeah. So what do startups that, then again, this is not about not business or entrepreneurs, it's more the startup and the business itself. Like, what do the startups that do succeed get right? What's the combination of things or the things that they get right? And then contrast that to what the startups that do fail, what do they get wrong?
yeah, I mean, there's so many factors, but I mean, I think startups that do get it right are, first of all, tend to be very financially astute. They have a very good understanding of expectations from stakeholders, from investors, etc. So, like, if you trust and respect the people that have funded you, that have helped you grow, there's a basic um, expectation and borderline human decency to not be wasteful with their time and money. So the number of entrepreneurs that come to us as investors and say, "Shit, I'm running out of cash next month. Please help me," is just downright irresponsible. It's insulting, right? So good founders, if they're going through a dry spell from a client perspective, they will always come and say, "Listen, we see something 6 months down the road. How can you help? What do you advise? Can you help us with A, B, C, and D? How can we?" I mean, it's almost like you over communicate with your investors, with your stakeholders, with your employees, and not wait until the very end to just to deliver bad news, um, without having genuinely sought advice.
But what about the startups themselves? What do they typically do? Like the startups, if you have to look at every single startup, and then not the specific entrepreneurs within the business, but the startup. What do they get right? Is it do they spend time working on the product? Do they spend time working on improving their marketing? What actually
No, I think it's
happens?
it's an obsession with helping to solve problems for their customers.
Yeah.
Product update, product improvements. I'm not saying anyone can do it, but I mean, but that's almost the easy part. But it's you know, startups that do well are the ones that are the most obsessed with customer satisfaction.
Yeah.
Um, the industry has a big problem with churn in general, especially B2C businesses. Consumer product, consumer retail, anything that is consumer driven
Yeah.
has a big problem with churn. It's a little easier in B2B, but startups who get it right know how to find the perfect balance of use of proceeds when they raise capital between acquiring customers, retaining the ones that do sign up, and then maximizing referrals from existing customers, and at the same time preventing existing customers from churning,
Yeah.
and constantly keeping your customers happy,
Yeah.
offering them bigger, better opportunities, um, to solve their problems, right? And incentivizing them. Um, Startups that don't do that, I mean, we live in a world where we are spoiled for choice.
Yeah.
If we don't use one ride-hailing company as another, if we don't use one online course to study something as another, if we don't use one food delivery company as another, if we don't, I mean, it's literally every industry touch and feel, from mobility to logistics to healthcare to education to agri, every industry we have so many choices. So if you don't treat your customers right, you know, the I've said this before, like, back in the 80s and 90s and even 2000s, early 2000s, the only two things that mattered for a successful company were quality and price.
Yeah.
If you price something low enough, it don't matter how bad your quality is, because at some point you'll always find a segment of the market that is so price sensitive that they will put up with poor quality. You see that in the auto industry. You can have very average cars in the market that aren't the best quality, but because your price is low enough, you'll have people buy it all the time.
Yeah.
Same thing with any industry, right? Price and quality are the two things that determine the success of a business. But in today's world, when I say today, I mean the last 15 to 20 years, I would say since 2012, 13, with the explosion, 2002, 2003, post the dot-com crash, and convenience and time are the two biggest commodities.
So
And startups that can maximize or maximize convenience and minimize time spent on something. Because let's be very clear here. I think, and a lot of people agree with this, the most valuable commodity in the world today is time.
yeah.
People have achieved so much in such a short period of time. If you take away time from a person, you take away more than just money.
Yeah.
And that, if you can optimize for that, then you, yeah.
Yeah. Um, when should Yeah. When should Okay, last question. So should founders actually raise money? So again, I run a software development business. We get a lot of early stage companies coming to us wanting to build software, and a lot of them tend to think that raise, as soon as they build the software, they can raise the next week. When should people actually start thinking of actually coming to a VC or an angel to raise money?
I mean, I'm going to say something that's a bit controversial here. Is I mean, this obsession with raising money is actually something that founders need to be very very cognizant of. First of all, founders, if you want to be an entrepreneur, you have to bootstrap.
Yeah.
You have to use your own money. If you don't have, I mean, if something can work with good unit economics at a small scale, it can work on a big scale.
Yeah.
Right? There's no need for you to raise hundreds of thousands of millions of dollars when you're at the pre-seed stage and spend all that money on marketing or sales or a team or tech. You're just being brash
Yeah.
and downright stupid. Unless you happen to live in San Francisco or in a part of the world where there's a free flow of capital on tap, you should never be doing that. So you should be, as founders, you should exhaust all your time, resources, and money to do it yourself.
Yeah.
Right? There are so many examples of companies. In fact, I just came back from um, an Africa India investor summit in Mauritius last week, and I saw and heard the story of a company called Zoho, Zoho,
CRM.
CRM,
Yeah.
but much more than CRM. It's just business enterprise software from, I mean, CRM to storage, to emails, to cost optimization, to HR, to, I mean, everything. Just optimizing business processes, mails, yeah, I mean, yes, storage, service, everything, you name it. Haven't raised a single dollar in venture funding, entirely self-funded, and the company, I mean, the execs, the employees own the company, and that company did not have to raise a single dollar in VC funding till date, and they are a unicorn because they have more than $1 billion in revenue, right? And I heard another company in the U.S. What was it? GoPro didn't raise. I'm not sure how much, but didn't raise venture funding until very, 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 very late, or maybe even didn't raise at all. I'm not entirely sure, but there are so many examples. I mean, only raise money once you have figured out your business model and you have been able to prove favorable unit economics doing it on a small scale.
No.
If you've been able to prove something at a small scale, then investors will say, okay, cool, my capital is going to be used entirely to help you take what you're doing well at this scale and to do it purely. Like, you should not be using venture money on anything but honing your tech. I said honing, not building. Honing your tech and spending on marketing and customer acquisition.
Yeah.
The number of companies that I see use equity capital, which is, by the way, it's pretty obvious, but I'm just repeating it here, the most expensive capital on the planet is equity capital.
Yeah.
Right? To do things like purchase inventory, purchase capex assets, to spend it on things like HR, basic operation systems. It's just, or I mean, like, anything outside of tech and marketing does not need equity.
Yeah.
And I understand that we live in a world where not all debt capital is cheap. You know, until recently, if you were outside of the US and Western Europe, debt capital is expensive. But you've got to figure other ways. You know, I don't think founders truly maximize the bootstrapping friends and family portion of their capital raise, and they want to jump into raising money from angels and VCs without putting enough skin in the game themselves. I don't think founders have enough skin in the game.
Yeah.
And why do you think it's okay to expect random third party people to give you money when you yourself don't have anything on the line? I mean, like, just a simple point, like, if you're a founder and you own anything more than a 3-bedroom house anywhere in the world, and you're coming to others asking for money, like, it's just downright no. Because you've put nothing on the line. Nothing. If you have plenty of assets in your personal name and you're coming to other people asking for money to build your pipe dream, you know, you may get a few VCs or funds that have play money or gambling money to give you money. When I say gambling, I mean money for free. Not money for free.
You don't want to offend anyone.
Yeah, like you know, extra money. But like, there isn't enough skin in the game.
Yeah.
And I think that's such an important facet when it comes to, because ultimately backing early stage ventures is so much more of an art than a science.
Yeah.
So much more, because you're investing in people. And what is a man or a woman if not for character? And that's a very, very important part of how you determine whether or not a venture is backable or not.
Yeah. All right. Thank you so much, Zach, for
Cool,
joining
man.
us today.
Of course, yeah.
Really appreciate the time. And I think we'll probably shout you out on the videos, and I don't know when this is gonna drop, so
Cool.
but I'll keep you updated.
Awesome.
Thank you
Cool,
so much.
man. You don't have to edit this or anything like that.
Yeah, no, I'm not gonna edit much.